welcome to the Capital Discussions QuantyCarlo Education. I'm Tom Nunemaker with my guest Larry Richards from QuantyCarlo/IOTA. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And with that, this disclaimer is at the bottom of all our web pages. If you care to read it in its entirety, and I will pass the ball to you. So Larry, welcome back while we're changing presenters. Good to have you.
Thank you, Tom. Can you see my desktop now?
I can.
Excellent. Okay, well, I'm going to show today, I thought I would show a very simple trade, and I thought I would do a directional trade, and I'll explain how the thought processes were in coming up with the trade. And as I look at the list of participants or attendees today, I see that there's some quite advanced traders, and some of these concepts are going to be things that you don't need to hear, but I'll just try to assume that, I'll try not to assume that anyone knows anything and just explain all the basics. But before I get into that, let me make a kind of announcement. We're always doing various innovation to try to make QuantyCarlo a more intuitive experience, and we have a few ancillary products that are coming out here in the near future, free to use for the QuantyCarlo community, of course. And one of those is something we call, for lack of a better word, the data viewer, okay? And let me just show you what the current version is. I've deleted out the URL here, so this is essentially the web page, and it does exactly what the name implies. It allows you to view the data that's behind the back tests that you perform on QuantyCarlo. Now, this is often, although you can see the option chains in the trade playback window, it's often useful to go through and just browse and see on a particular date what strikes were available, what were the prices, what were the credit what was the credit I might have gotten if my entry rule had triggered on a certain day. So this is essentially a prototype that we have at the moment, which is almost ready. You can see that it is almost ready. I'm showing the SPY. You see the underlying price at the top, then we've got the calls and we've got the puts, and you can see that we've color-coded so that the ones in the middle are plus or minus 1 standard deviation. These are standard deviation cones. Then we have the plus or minus 2 standard deviations, and everything beyond that is a different color. So I hope that you will enjoy this. We plan to announce the URL, if not today or tomorrow, very, very soon. I just have a couple of developers working on this to tweak it, and we're really looking forward to getting the community feedback so that we can actually improve this and tweak it and make it even more of a useful tool for everyone. So please participate in our beta test. We want to do a beta test for maybe a week, get your feedback, and then we'll announce it generally available to everyone. I have, as you can see, I've got buttons here to add the different Greeks as you like. If you want to see the, I mean, by default, you should see the mid price. I will say that our agreement with our data vendor is such that we cannot disclose the bid and the ask price. So we do show only the mid price. We are allowed to show any of the prices that we derive ourselves. Now, while I'm making announcements, let me just make one more announcement. Actually, this past week, we just launched an open source quant library for the Python programming language. And this is something that we're actually now using in QuantyCarlo. It's something that if you're a programmer, you might be interested to use. It's quite a unique and special library for calculating option prices and option Greeks and implied volatility, especially implied volatility. I can say that you will find no other program that calculates implied volatility faster or more accurately than this library. Let me just type the URL in. It's called vollib.org. And you can actually go in and see the source code because it's open source. So we've hosted the source code at GitHub. You're welcome to view the source code. And we also have the documentation here. So you can see that we have black Greeks, we've got the black implied volatility. This is for futures options. And then we've got Black-Scholes Greeks, Black-Scholes implied volatility. And then we've got Merton for if you have equities with dividends. So I encourage everyone, please go to vollib.org and take a look at this. And if you're a programmer, if you're a Python programmer, you can actually install this with one single command. Doesn't matter if you're running Windows or if you're running some other operating system like Mac OS or Linux. It works on all three. So having said that, those were the advertisements for today. Today's program has been brought to you by our sponsor, Vollib. So now I shall get into the trade part and show you the trade that I've come up with for today using QuantyCarlo. And I'd like to show you a little bit about how I've built it. But first of all, let me show you just to give you an idea of what the context is. Let me show you the trading results. So I've got this is a directional trade. I've got a bull version and I've got a bear version. Turns out that the bull version works better than the bear version. They're both profitable, but the bear version is not as profitable. So I'll show you the bull version. Let's see here. So you can see that it's a little bit jagged. We started off with our Capital Discussions trading account that starts with $10,000. And this is going from 2004 to 2008. And it wins $2,000. The return on average margin annual return is 3.7%. Not so exciting. Let me show you this is a little bit more exciting. This is actually from 2013 to 2014. In this particular period of time, we got an average of 77% return on investment. So it's quite, this was actually the first back test that I ran. So I was quite interested and quite pleased that I got these results. Now let me show you the thought processes that went into this. Let me show you first of all the trade that I put on. Now this is my bull call debit spread. Now notice that I've got a long call over here on the left, and I could have just done this with a long call actually, but I figured if I'm going to pay for a long call, I'd like to get a little bit farther out of the money and sell some of that premium to sort of defer some of the cost of this long call. In return for selling premium, I'm actually giving away some of the upside, but I don't really care. I want to get maybe half my debit. You can see my debit is maybe this much, and depending on where I place my strike, I'm going to be able to get, you know, well over, if my directional, remember this is a directional trade, okay? So if my directional indicator is reliable, then I should be able to make at least as much as my debit or more, if depending on how I select my strikes. Now, how did I select my strikes? Well, you can see the name of the strike selectors here. The first out of the money call strike is what I chose for my long. And for my short, I chose the fifth out of the money call strikes. So I didn't want to limit my upside too much, so I chose the fifth strike out. That gives me a little bit of premium to help defer the cost of my long call. Okay, now let's take a look at this in a preview. If we preview this, you can see that using these strike selectors, we get a trade that looks something like this. Let me zoom in a little bit. That's too much. Let me zoom in a little bit. Zoom in a little bit more. So that's essentially the shape of the trade. And you can see that for my long, I'm paying, under this particular scenario, I'm paying $16.91. And for my short, I'm getting back $9.26. So I'm paying about $7 for this spread. Whereas if I had just bought the long, I would have paid 17 bucks. Okay? So that's the whole idea, is that we've got a directional trade. It's got a nice risk to reward ratio. The risk, you can see I'm taking for each one of these under this is a simulated market, mind you, but in this particular setting, I'm risking $750 in order to get $1,250, which is pretty good risk to reward, I would say. So we're starting off with that. Now what's missing? We're missing our directional indicator. So let me show you, I'm going to leave the QuantyCarlo interface for just a moment to show you my thinking about the directional indicator, and then I'll show you how I created it. Okay? Now, I'm going to, first of all, just assume that you don't know what a technical indicator is, which is going to be probably false for 99% of the people attending. But just as a review, please indulge me. We've got a signal, right? Not a signal, but an underlying asset, okay? Now, if we have a really good indicator, this is over time, and this is my underlying asset price, okay? If we have a really good indicator, our indicator is going to give us a sell signal here and a buy signal here, and then maybe it'll give us a sell signal here and a buy signal here. So what we're looking for is, over time, we get these signals that tell us the direction the market is going to go in the future, okay? Which is easier said than done. But a lot of people actually trade this way, and with some success. So how did I design my particular indicator? Well, right now in QuantyCarlo, we have a limited supply of technical indicators, but we do support Bollinger Bands. So I decided to use Bollinger Bands and create a very rudimentary technical indicator that gave me buy and sell signals. And I'll show you how I built that. But first, let me draw a diagram of how I was thinking. Okay. So a Bollinger Band essentially has a top and a bottom, okay? I think in QuantyCarlo we call this the upper and lower part of the band. So this is the upper, and this is the lower. And then what I said is that, you know what, prices tend to revert to the mean. That's my hypothesis that I'm starting out with. Now, if prices tend to revert to the mean, that should mean that they bounce off the bottom of the Bollinger Band and they bounce off the top of the Bollinger Band. So if I'm anywhere near the upper part, that should be a bearish signal. That should tell me to sell, because it should tell me that the market is basically going to bounce off the top. Whereas if I'm close to the lower band, then I'm postulating that the market is going to bounce off and change directions and go up. Okay? So what I did is let me change colors here. I created a boundary so that if this is my total width, okay, of the band, let's say I've got, this is the total width. This line here would be the top 20%, okay? And this would be the bottom 20%. So essentially, my indicator, which is very, very simplistic, just says that if you're in the upper 20%, sell or be bearish. If you're in the bottom 20%, be bullish, okay? That's just the general concept behind this. Now, that's how I started out thinking, and let me show you how I created the indicator. So I will switch back to the QuantyCarlo interface here. Now, I started out with some simple expressions. Let me just show you what I did with my my bullish trading plan, okay? This is my bullish trading plan. Now, I created a couple of variables here. I named the two variables bearish signal and bullish signal, okay? And what I'm doing is essentially updating these signals at every timestamp. And the thing that updates them is this pre-entry rule. So the pre-entry rule is basically, it has one job, and that is to update those variables. In this case, I'm just doing the bullish side of the spread, so I'm only updating the bullish signal. And so I've created this rule that says if I'm in the DTE window, and the DTE window is another expression that basically I've chosen 80 to 40 days to expiration. Why did I choose 80 to 40 days to expiration? I figured I don't want theta to be working against me. So I wanted to get out pretty far from expiration so that I wouldn't be decaying so fast. So that's the reason I chose that. Now I've got this variable here, bullish signal, and I'm just assigning to it the value of bullish. I've given a Boolean expression here which is bullish. Now this contains my indicator. Whenever bullish is true, that means that we have reached the lower 20% of the Bollinger Band. And I can show you how we created that. Let's drill down a little bit. Okay, inside that, I've actually, I didn't really need to say this, but I've said I'm in the DTE window and I've got my Bollinger Band buy signal, okay? That's what I mean by bullish. Now let's take a look inside the Bollinger Band buy signal, okay? S, which is the underlying price, is less than lower Bollinger Band lower, BB lower, plus 20%, okay? Now how did I come up with that? Well, let's drill down a little bit lower. So I like to create these expressions in small atomic pieces rather than create a big monolithic complex expression. I like to create a lot of small expressions and then combine them. So we've got this. The reason is because I want it to be easy to read. I think this should be easy to read. S is less than BB lower plus 20%. I think pretty much anybody can understand what that means. Now let's drill down into what this is, BB lower plus 20%. Okay, I'm opening that up. Okay, that means that we're saying BB lower plus BB width times 20%. Okay? Well, BB lower is just, it's a built-in thing that I put a wrapper around. You can see. This is the Bollinger Band. What I'm doing is I'm taking a 20-day period, a 1-day period, 20-day width with a 2 standard deviation. And this is an exponential Bollinger Band for those of you who are familiar. We have also simple Bollinger Band. We also have exponential Bollinger Band in case you want to explore those. So what do I mean by Bollinger Band width times 20%? Well, let's drill down a little bit further. Basically, that's just the BB width, the Bollinger Band width, times 0.02, or 0.2. Okay? Well, how did I get the BB width? Well, I've got BB upper minus BB lower. And this BB upper and BB lower, these are just convenience wrappers that I put around the longer default expression. You can see that BB upper is very short, which I like. If I open this up, you can see that this is the way it looks normally in QuantyCarlo. It's very long. It says underlying asset, indicators, Bollinger Band, EMA. So I'm using exponential moving average, 20, 1 day. Those are the parameters, and then plus 2 standard deviations in upper. So that's very, very long and hard to read for me. So what I do is I put it in a wrapper I just put this into a numerical expression and I rename it as BB upper, okay? So now, what do I have? I've got a hypothesis that I have a signal here that tells me when I should be bullish. And I want to build a trading rule around that. So it's quite simple. I say, here it is. Whenever you're in the DTE window and you get the BB buy signal, okay, then buy 4 bullish call debit spreads. Actually, I changed this to 1 because 4 ended up being too expensive and my drawdown was too heavy. So I changed, it says 4, but I changed it to 1. So this is my entry rule. And then I added a exit at max loss. Exit at max loss is pretty simple. I've got an expression here that says hit max loss. How did I do that? I said whenever my position current loss is greater than or equal to my position debit multiplied by half, 0.5, then I'm going to say I hit my max loss. That's how I define hit max loss. And then if I hit my max loss, I'm going to close the trade. Likewise, on my exit at target profit, I've got hit target profit. Again, this is just position current profit greater than or equal to my debit multiplied by 0.5. Okay? Very simple. So whenever I hit my target profit, I'm going to close the trade. All right, just a little bit of risk management here. I don't really need risk management so much with this trade. That's the beauty of a debit spread, is that you're by default your loss is capped. Okay, so really this exit at max loss is maybe a little bit of extra protection that I don't necessarily need. It depends on how you select your strikes. And of course, another thing to point out here is that I've arbitrarily chosen a lot of different numbers. Who's to say that 20% is the correct number, right? In my Bollinger Band, who's to say that 20% is the optimal number? I don't know. It's just the first one I drew out of the air. Okay. Also, who's to say that if I look at my call debit spread, what I'm doing is I'm choosing for my long my first call out of the money, and I'm choosing for my short my 5th call out of the money. Now, who's to say that that's the optimal combination? Well, I don't know. I could actually play around with these and find a more profitable combination that, and maybe what I need to do is have a better risk-reward ratio. But the point I was making is that you can see that by default the debit spread has it has a capped risk, which is one of the nice things about it. Still, you know, if I'm winning on average, let's say $500 when I win, I don't want to be losing $750. So putting in an exit at max loss does seem to make sense to me. Okay, and what it does is it smooths out your profit and loss. Now let's go ahead and run this trade. Okay. Just to see. Now I've tried it over different periods of SPX. This is my bull debit spread strategy. I'm starting out with Capital Discussions account, which starts with $10,000, by the way. And let's run it over. Well, I've already shown you what happens over SPX. I haven't yet run it over at RUT, okay? So this will be interesting. Let's see what happens over RUT, which I'm just going to do this live. I don't know what the result is going to be, but it seems to have worked over SPX. Let's see if it works as well over RUT. Okay, I'm just going to submit this job. I've got my RUT monthly expirations. I've got my bull debit spread strategy chosen as my trading plan. I've got my capital discussions trading account with $10,000. Let's start. Let's give it a try. Do you want to save this? Yeah, I'll go ahead and save that. And now I'm going to name this RUT so that I'll know later which underlying I used. This will take a couple seconds. Boy, I hope it's profitable over RUT. You know, this Bollinger Band indicator is surprisingly effective, I've found, in general, in spite of its simplicity. While we're waiting for the results, I will let you know that many people have requested a feature whereby we read in an external signal. I know that a lot of people out there use products like Aeromir and other platforms that generate technical indicators that generate buy and sell signals. And they just want to test using those signals in QuantyCarlo. So what we're going to do is implement the ability to read an external event list, is what we're calling it, an external event list, using a CSV file. So you'll prepare a CSV file from Aeromir or whatever you use as your external trade signal generator, and then we'll just read it into QuantyCarlo. That gets submitted to the server, and actually we're working on prototyping that right now. So I hope that it's going to be ready, you know, within a couple weeks. Of course, we're working on a lot of different things at the same time. So if that were the only thing we were working on, it'd probably be ready tomorrow. But it's going to take a couple more weeks to get ready. I think
Larry,
this is going to be.
Is that going to be just for end-of-day data for that, where you can import the external signals?
I'm sorry? For end-of-day data?
Yeah, where you were importing your signals, is that with end-of-day data, or you're also going to do intraday?
We're going to have a column that's the date, and then a column that's the time. So if you want to have your signal only be true at a particular, let's say you've got a column that's a bullish, a bear signal. Let's say you've got two columns, a buy signal and a sell signal, okay? If you want to have those occur at a particular moment in time, like a particular timestamp, then you can do that. But if you want it to happen and stay, like if you've got a buy signal and you want it to be buy all day long, then you can just leave the time part blank, and then QuantyCarlo will treat that as a buy signal all day long. And then whether you run this over intraday data or end-of-day data, that's up to you.
Very neat. Look forward to that one.
Yeah, I think it's going to be quite a useful feature because, obviously, while we support a few technical indicators, and we're going to continue to increase our library of technical indicators in QuantyCarlo, obviously, there's still going to be people who have their own, right, that we don't support, or that maybe it's a proprietary signal that people don't want to disclose. So in that case, this being able to read it in via CSV file without disclosing the algorithm that generated the signal is certainly going to be useful for a certain subset of our users.
Absolutely. Looks like we're almost done.
Yes, boy, this has taken a long time. I wonder how many years of RUT I did. Okay, looks like we were profitable. It says over 2004 to 2014. So we've run it over, looks like, a little bit over 10 years. We've done 90 trades. Notice that this is one of the beauties of having a technical indicator, is that you don't trade every month. Some trades you skip. Some months you just skip. If there's no buy sell signal or sell signal, you just do an aborted trade. You don't do a trade that month. And let me sort here on risk. Sorry, no, I want to sort on let's see. Let's sort on P&L. Okay. So the maximum I made in a single month was $1,294. And you see that most of the numbers are red. And if I come down here are the losses. The losses seem to be overall smaller than the wins, which is why we made a profit, actually. And also, we seem to have more wins than losses. Let's go back to our summary chart here. Net profit, $10,600 over, we started out with $10,000. We ended up with over $20,000. So we doubled our money over 10 years. Our return on average margin is 7.75%. Not bad. What's our win-loss rate? Our win rate is 58%. Okay. 40 trades we just stayed out because we didn't get a signal. 90 trades we did, and 52 we won, 38 we lost. So, okay, there you go. I didn't know how this would perform over RUT, okay? Had no clue whether this would be profitable or not. And you notice that actually even during right here, this period of time, this is probably our max drawdown, and this is the subprime crisis, right? The crash. So at this moment in time, we actually had a big drawdown, and we got down to about $8,000 balance, okay, in our account. And we stayed there pretty low until 2010, and we started our ascent again in 2010. So, notice that, even though we had the subprime crisis here in the middle, still we're able to trade right through this thing and end up with a fairly respectable return on risk, 7.75% annually. So, I think at this point I'll open it up for questions and discussion.
You want me to promote everybody?
Sure, yeah.
Okay, here we go. So if you'd like to participate and call in, you can. If not, you're welcome to continue listening with the audio broadcast. So any questions for Larry? Somebody must have a question. It sounds like everybody's happy so far.
It seems like one Milborn has joined by voice.
And Spencer Preston.
Yeah, I'm out here.
Hey, Spencer.
Spencer, have you had a chance to try the software? Any questions when you're trying to use it or problems you've had?
Well, I ran into a couple of things here the last couple of days. I'm in the process of trying to write up so I can send them to you. Some inconsistencies and some funny results.
Okay. Please send those along.
Yeah. Kind of goes, a lot of it's wrapped around going back to that issue that I discussed with you, Larry, about entering on a specific day after expiration.
Right. Yes. That is something that, was a total surprise to us that people would be interested to enter on based on not the days till expiration, but the days after expiration. Because I come from the Sheridan Options Mentoring sort of background where basically everything is predicated on days till expiration, never days after expiration. But building that into the software should not be. It's just an engineering problem like any other engineering problem. So we'll look to support that.
Yeah.
Currently, you have to kind of jump through hoops, and still it's not even possible, I don't think.
Yeah, I haven't been able to get it to do it yet. But one of the if there were always the same number of days between any two consecutive expirations, it wouldn't be an issue. But
Right.
Sometimes there's 4 weeks, and sometimes there's 5 weeks, and sometimes there's an extra day thrown in there, like on leap years.
Sure.
And that's and if you have a trading plan where you always enter on a specific day, and it's predicated on 3 days after you just expired, that's but people do that in some
Sure.
very common type automated
Sure.
thing.
I think the rationale for doing it a certain number of days to expiration is because a lot of people, if they're positive theta traders, theta tends to depend very much on the time to expiration. Theta decay actually is fastest in the last 30 days, right? And then as you get closer and closer to expiration, the theta decay is speeding up. And as you get farther from expiration, your theta decay is slower. So if you always start in a certain DTE, days to expiration window, you're pretty much you can pretty much be confident that your theta decay is going to be at a certain rate. And I think that's the rationale. I'm not saying that that's the correct way of trading. I'm just saying that's the rationale for doing it that way. But I can understand that if you're not if you're not trading for theta, if you're not doing theta trades, right? Then maybe you're like, for example, if you're just doing a directional trade and you don't really care about theta decay, or you want to be maybe theta decay is not a big factor in your mind, then I can understand how you would just want to get into the next trade as soon as you've got out of the previous one.
Yeah, yeah.
Hey, Larry, there was a question from Joe. Do you have a way to use IV rank for a particular underlying as an entry condition?
Yes, we can indeed. In fact, the way I would do that is just to create a, let's say, an expression like this. If I go to the underlying asset, actually, what I want to do is go to the in the underlying asset, I have the historical volatility, 3, 6, and 12 month. But that's not what we want. We want the implied volatility, right? So we want the option chain. And in the option chain, I've got the front month expiration, and here it has the implied volatility. So what I would do is I would say, if I'm looking for a particular range, I would do this. I would put an and here, and then I would say that it's less than or equal to a certain amount, and then greater than or equal to a certain amount. So let's say, for example, I want my implied volatility, okay, to be less than or equal to, let's say, 35, right? If it's over 35, I don't want to trade, okay? And if it's under 20, let's say, I don't want to trade. So I'll put a 0.2 there, and there we have it. So what this says is implied volatility is less than or equal to 35, and implied volatility is greater than or equal to 2. Is this what you were? Is this what you had in mind?
Larry,
I think he's looking more for a ranking. So say like the IV range over the last year, maybe you only want to do calendars if your IV's in the bottom 20% of the IV range for the previous year, or something like that.
Ah, I see.
On the TOS platform, they've got an option statistic available now that shows IV ranking.
Okay, in other words, ranking of multiple symbols?
No, percentile.
Oh, percentile, I see. Okay, so the IV ranking of the percentile of a certain underlying over the past 12 months or something like that.
Exactly.
Okay, no, that's a very interesting thing to add. We haven't implemented that, but that would be very interesting to add. We have the data, so it's just a matter of putting the algorithm in. So I'm going to take a note of that.
I know another thing that people use is, say on the volatility products, maybe they're looking for a VIX level for an entry or for an underlying.
I missed that, Tom. Could you repeat, please?
A lot of people will use, like, say, the volatility, maybe ranking for, say, the VIX when they're trying to do a trade on the SPX. Is it possible to combine tools like that?
Right, sure. So then you get the volatility of volatility.
Or maybe like a IV ranking of your VIX to help with your trade decision, maybe a trading rule.
Sure. No, that sounds interesting. I will put that down as part of our roadmap.
And there are some of us that don't care about the VIX. Like I'm more interested in the RVX.
Yeah, exactly. So you could put any instrument that you wanted.
Right. Well, right. The RVX is the VIX for the rut, right?
Correct.
So essentially, what the RVX and the VIX are weighted averages of a forward volatility. Okay, and usually these are 30-day forward. And we have actually installed the forward volatility data based on our own calculations, of course. We don't use the RVX we have the VIX, but of course, but we don't have the RVX. But we calculate the RVX essentially using the same methodology. So, and not only that, we have it for every underlying. Okay. So it's a matter of adding it to the client, and then it's going to be available. But this percentile ranking is something that we haven't done yet.
Good afternoon, Larry. This is Dan Harvey. How are you?
Fine, Dan. How are you?
Oh,
Hey,
doing
Dan.
fine. Hey, Tom. I just wanted to say I think this was an excellent study and demonstration, Larry, and I think it certainly illustrates the versatility of QuantyCarlo, and also I think that as you continue to add some indicators which would allow QuantyCarlo to explore credit spreads and debit spreads, and really all varieties of spreads, I think it just will get better and better. And for example, in this particular case, you used Bollinger Bands. You know, some users, such as myself, might have done something like if you want a bullish debit spread, like a bull call spread, in other words, you might say that the 50 period moving average is greater than the 100 period moving average, and then the signal is taken when the underlying price crosses above the 50 moving average from below. That's a signal that a lot of futures traders use, for example, but it also works for indices and also for equities. That's just an example, but anyway, I think the more indicators that you get, the more versatility that we're going to see in QuantyCarlo.
Well, thank you, Dan. That's a great suggestion, and those were kind words. So thank you for that. You know, another thing that it's a kind of a challenge when using QuantyCarlo with these indicators is visual feedback. You know, typically when people are using a backtesting platform, they immediately think of they associate the technical indicators with visual feedback. And right now, you know, you don't see any Bollinger Bands. You saw the word Bollinger Band, but you didn't really see any graph of a Bollinger Band. You don't get that visual feedback at this moment in time. But we're planning to implement that as well, and I think that will help people to, let's say, make it more intuitive when you do design an indicator like this, like you were describing.
That makes sense.
Any other questions for Larry?
This is Spence again. Larry, could you real quick go back to where you set up the pre-entry conditions?
Sure.
I'm going to take a look at that again. Because I was playing around with doing some of that today, and it wasn't quite working for me. And I see what I see what I'm doing, or I see what I'm not doing to get it to work.
Okay.
So the assigned value to variable is
Right.
what I'm seeing.
So if I wanted to build this from scratch, let's say I've got my my bearish or my bullish. Let's say I've got my bullish signal already defined. Okay, and I want to assign this value to a variable. The variable in this case being my bullish signal. Okay, which I've defined here. Let me just pretend that I haven't defined it. I'll delete that, and oh, now it's inherited. So let me create a brand new trading plan that doesn't have any inherited variables. New trading plan. No. Okay, so I'm going to come up here and I'm going to say I want to have a variable and I'm going to call it my bullish signal. Okay, I'm going to initialize it with okay, I've got to make this a Boolean because it's true or false. I'm going to initialize it with false. Okay. So by default, it will be off. It will be turned off. Okay, so now I've got a bullish signal as a variable inside my trading plan. Now the job of my pre-entry rule is going to be to update this variable so that I can use it in my trading rules, in my entry rules to be specific. So what I'm going to do is I'm going to create a trade rule, new trade rule expression. A trade rule basically says when this happens, do this. Okay? So what is it that we want to happen? Well, in this particular case, we want the whenever we are in the DTE window, okay, this is a expression that I've already defined. This is my DTE window. It says DT is greater than 40 and DT is less than 80. Okay, so in my pre-entry rule, I need to give it that. Why do I need to give it that? Because that tells me what my front expiration is. Okay. If you don't give it a DTE in the pre-entry rule, you don't know which expiration you're measuring against. Of course, if you're just doing a signal on the underlying, then DTE is irrelevant. You could say, but actually, when you enter a spread like a debit spread, then DT is certainly relevant. So you definitely want to know that you're in the time window. So that's why we've made this a prerequisite for a pre-entry rule. You always want to have your time window here, otherwise it won't accept. Then what is the action we want to do? Well, the action, go down here to action templates, is we want to assign a value to a variable. So I'm dragging this over. So now I've got this assign value to a variable. I know the name of the variable that I want to, because I've already defined it, right? And I've got my trading plan open. It already sees the bullish signal there, so I don't have to, all I have to do is, it's already pre-selected for me. The only question is, what value do I assign? Okay? and the value that I want to assign is the one that I just defined as bullish. So I'm just going to drag this bullish over, and voila. Now, at every once we're in this DT window, at every timestamp, the trade rule, the pre-entry rule, this pre-entry rule that I've created is going to assign a value to this variable, bullish signal, based on this logic that I've created. That basically it's either going to be true or false, right? So does that help, Spencer? Is that
A lot.
Is that clear? Oh, super. Jay asked, can you specify an IV for a particular option? You can, I believe. Let's say you're looking for a particular option. What you need to do is you need to specify the strike, right? So whenever you want to get the attributes, let's say I want to get the current premium of a particular option, the current delta, the current theta of a particular option, what I need to do is I need to specify what strike I'm talking about, right? And that is a very, very what I want to say is that there are so many different ways of specifying which strike you're interested in. But the first thing you have to do is choose one of the methods of specifying a strike, and we have many, many ways of doing that. So let's say, for example, I want to know the implied volatility of the strike that is one standard deviation above the market. Let's say, for example, okay? So what I'm going to do is come over here and I'm going to say strike by standard deviation of price movement. Okay. So first standard, okay. So here's my standard deviation strike selector, and I'm going to say first, let's say one standard deviation out of the money. But rather than say out of the money, in this case, let's say I want to do below the underlying. That way I don't have to worry about whether it's a put or a call. If you say out of the money or in the money, you have to worry about whether you're talking about puts or calls. I don't want to worry about that. I just want to say one standard deviation below the underlying, okay? And then I want to say the first available strike outside that. Okay, so you could also say first available strike inside that, or the closest available strike to one standard deviation. But I'm going to choose the first available strike outside that. Okay, so now I have that, and I can then say, okay, save this. Let's say 1 stdev below market. So now I want to let's see, how do we do this?
You want to do put an and in the when this happens. So in DTE window and
Can you select a strike based on IV? Yes, we can do that. But let's continue this train of thought. Spencer, you were saying that I want to have an and condition. But it doesn't accept.
Well, go ahead and put your and operator in there.
Okay.
And now for the left-hand object of the and, try your strike selector.
It wants a Boolean expression though. That's why it's green. You know what? There is a way of doing this in a pre-entry rule. There is a way of doing this. I've never done it before actually, so I'm going to have to take this as homework and come back next time. But Jay was asking how to select strike by IV. That's a little bit easier actually. So let me demonstrate that. So what I can do is I can say strike by option attributes. Okay. So if I want to say implied volatility, okay, I can say that my call implied volatility is greater than or equal to, let's say, okay, my call implied volatility is greater than or equal to, let's say, 0.18. Now, there's a reason why I'm choosing 0.18. Because in this simulation here, when we do strike selector preview, all of the volatilities are the same for all strikes. So it's unrealistic in that sense. You don't get the volatility smile like you would in real market data. But let me set implied volatility at 20%. So you're not going to select a single strike using this strike selector preview. So what I'll do is I will, in order to make it a single strike, well, that's kind of a limitation we have. We don't have at this moment in time, we don't have a simulated volatility smile. So every strike will meet this criteria. So, but this is how you would do it, Jay. If you wanted to select a strike by implied volatility. Now, one thing to note is that there are going to be multiple strikes that fulfill this this condition. So what you'll need to do is you'll have to add another filter, which would, in this case, we want, right, the call implied volatility is going to rise the farther you go out of the money, right? So essentially, you want the lowest available strike that has call implied volatility of greater than 0.18. So I'm going to go up here and under compound selectors, I'm going to say, or you could say as close as possible. That's another way of doing it. Or you could say the lowest available strike. So in this case, I've got the lowest available strike such that call implied volatility is greater than or equal to 0.18. And that is something that we could preview. And once again, it's just going to give us the lowest available strike because all of the strikes are at the same implied volatility. So here's the one that was chosen in this case. It chose the 400 strike, which is the lowest strike that we have. But in a real market with a real volatility smile, you would get another strike. Jay, does that make sense?
And while you're waiting for Jay, Hans says, how about an entry condition only when IV, the underlying, is up for the day?
IV of the underlying is up for the day. Aha. So yeah, there's no quick way to do that, but there is a way to do that. So what you would need to do in that case is you want to save yesterday's IV with a variable. So what I would do in that case, and you know, if this is a requirement that you want to have, if you want to have an easy way to do this in QuantyCarlo, please send me a note or put a suggestion on the QuantyCarlo forums suggesting how you would like this to behave, and we can make it easier than this. It should be easier than what I'm about to describe, but what I would do is I would create a variable. I would call it yesterday's IV. I wonder if it's going to take apostrophe. And this will be a number. Maybe I'll initialize it with 0. Okay. So I've got yesterday's IV here, and that's a variable. And then what I would do is I would, let's see, you want to compare today's IV with yesterday's IV and see if it's risen substantially or fallen substantially. I believe that's what the intent is. So then I would say today's IV. And what I could do is that each day I would put a rule that assigns a variable, a value. I would assign today's IV and yesterday's IV. I would just take from the previous value of today's IV. I would just move this over to yesterday's IV, and then I would populate today's IV, and then I would do my calculation, right? Which is kind of a little bit of work. Okay, I admit it's not a very user-friendly way of doing it. It should be much easier. Okay, I see what you mean. Hans, you want to get more credit when you're selling your spread. So yeah, so if you want to know if IV is moving up compared to yesterday, this would be a way of doing it. And you could also compare a percentage. You could set a threshold, right? So once these variables are declared, then you can come in and create a kind of expression. So I go down here to variables and I say that let's say today's IV, let's say today's IV divided by yesterday's IV. Today's IV divided by yesterday's IV. So and then I would save this as, let's say, today versus yesterday IV. So now I've got this value, okay? And then then I could go in and I could create another expression, like say, now I've got today versus yesterday IV, and I would say that if it's greater than, right, if it's greater than, let's say, a certain value, let's say 1.3, I want it to be up 30%. Okay. Yeah, I'm going into more detail than necessary, Hans. You're very welcome. So that's how I would do it. So I noticed that we've been going for about an hour and 15 minutes. Maybe this is a good time to wrap up. Any further questions?
Yeah, that's what I was going to say. Really thank you, Larry, for coming, and everybody for staying to the end and all the good questions. We'll have another one of these in a few weeks, and in the meantime, the forums at QuantyCarlo are a great place to post questions as it gets seen by Larry and the other developers right away.
Thank you so much.
Thank you.
All right, thanks everyone. We'll see you next time.